Welcome back. In this video, we're breaking down one of the most important foundations in accounting. That's T accounts, the accounting equation, and how debits and credits actually work. Every transaction in accounting hits at least two accounts, one debit, one credit. A T account is just a simple way to visualize that. Debits are always on the left, and credits are always on the right. On the balance sheet, assets increase with debits and decrease with credits. Liabilities and equity increase with credits and decrease with debits. And on the income statement, revenue increases with credits, expenses increases with debits. At the end of the year, the net income flows into retained earnings on the balance sheet. An easy way to memorize this is the acronym American Eagle, which stands for AE. That's assets and expenses, which increases with debits and decreases with credits. Liabilities, equity, and revenue is the opposite, which increases with credits and decreases with debits. The accounting equation. Everything in accounting revolves around this one equation. Assets equals liabilities plus equity. It always has to balance. Let's say you issue stock for cash. You debit cash for $100 and credit common stock for $100. So assets go up, equity goes up, and the equation stays balanced. When calculating profit, that's revenue minus cost of goods sold equals gross profit. And that gross profit helps grow equity through retained earnings. Methods and organizations. There are two main methods of accounting: accrual basis and cash basis. Accrual basis, which follows the matching principle and records transactions when they happen. This is the GAAP method. Cash basis is when it records only when cash actually moves, when cash exchanges hands. That is not GAAP compliant. Under GAAP, rules are set by the FASB in the US. Outside the US, many companies follow IFRS, which allows for fair value adjustments and no LIFO method. Inventory systems. Inventory can be valued in different ways. The main rule is just record it at the lower of cost or market value. So higher ending inventory means the lower cost of goods sold and higher net income. So they are inverses. Lower inventory means higher COGS and lower net income. Methods: FIFO, LIFO, and average costs. FIFO, first in, first out. Older costs leaves first. LIFO, last in, first out. Newer costs leave first. Average cost takes the total cost divided by total units. Note that in times of rising prices, FIFO gives higher income. LIFO gives lower. So here's a quick summary. Debits equals left, credits equals right, always. Assets equals liabilities plus equity. That's the accounting equation. Revenue increases equity, expenses decrease it. GAAP and IFRS guide how financial statements are built. FIFO, LIFO, and average costs affect how profits are reported. If you found this helpful, drop a like and subscribe. Let me know which topic you want next: journal entries, adjusting entries, or the full income statement breakdown.